In this video, we are going to discuss moving average as a trend filter. Moving average is a widely used indicator. Most of the traders use moving average as a trend filter. Understanding trend and filtering out trend are two different use cases. You identify trend using market structures. It's a method of plotting swing high and swing bottom. But whether the trend is in the right direction, whether market structures are forming in the direction of the trend, can be understood through moving averages. Because moving average is the first derivative of price. We put all the data set together and divide it by the number of period, which gives us a smoothing line. That is moving average. Moving average, if we have to plot, we can plot it based on closing prices, which is popularly used method. Let's say we are plotting 21 period moving average. That means we are trying to identify what's the average buying price for the last 21 period. Now the period can be anything. It can be 15 minutes, it can be 30 minutes, it can be 1 day, 1 week. When we say 21 period, that means we are collecting 21 data set. And because we are plotting this exponential moving average or maybe simple moving average for the last 21 period, that means we need 21 closing prices. Based on it, we plot the moving average. In this course, we are going to discuss exponential moving average. There is a very basic difference between simple moving average and exponential moving average. Simple moving averages give weightage to all the data set, whereas exponential moving averages give more importance to the recent data set. So exponential moving averages makes lot of sense for a trader, because as a trader we need to understand immediate trend, and when we are trading options we have to understand a very short term view. That view can be identified through exponential moving average. So in this course, we are not going to plot just based on closing prices. We are going to plot two moving averages, which we call it as moving average band. We are going to use high and low as two data set to plot the moving averages. So it's a substitute to moving average based on closing prices, because when we plot based on closing prices, we have only one smoothing line. And moving averages as a trend filter also acts as a dynamic support and resistance. Let's say we are in a bullish trend. We are plotting higher highs and higher lows. Every time price coming towards moving average sees a bounce. That concept is known as dynamic support. If we are bearish, we are forming lower lows and lower highs. Every time markets bounce towards the moving average, they might take a resistance. So this concept is known as dynamic resistance. Moving averages are largely used to identify dynamic support and dynamic resistance. So when we have support and resistance, it cannot be a line. We need a zone. So as we want to plot a zone, so we are using high and low channel instead of closing prices. Because when we use high price of last 21 period, then we are calculating the range of the market, the range of the candle, range of last 21 period candles. If we are using a 21 period exponential moving average, we are just identifying a range. High low band helps us identify range of the instrument for a X period of time, whatever period of time we are using that exponential moving average. In this course, we are going to use 21 period exponential moving average both on the underlying chart, which is Nifty or Bank Nifty chart, and also on the option chart. So if we are using straddle or strangle, or if we are using a naked option, we are going to use the 21 period moving average, the high low band. And if we are plotting it on the underlying, we are also going to use the 21 period moving average. For us, for analyzing the trend, we are going to use the 21 period exponential moving average across the course, across the strategy to identify the trend of the market. The reason of using 21 period moving average is roughly in a month we have 20 trading sessions. We want to identify a trailing support and trailing dynamic support and resistance price for last 1 month period. So for us it makes a complete sense of using 21 period moving average. We are just calculating the dynamic support and resistance based on the last 1 month data, which gives us a sense what we can expect from the market. And if markets are reversing, we get an early signal. There are other moving averages that can be used, which is 50 period, 89 period, 200 period. Options can be traded for a weekly expiry, for a monthly expiry, or for intraday. They cannot be traded for a very longer period of time. So 50 period exponential moving average, 89 period exponential moving average, and 200 period exponential moving average makes lesser sense for an option trader. For option trading, we need price to move fast. We have to be more reactive to price. And when we are using the first derivative of price, which is not price in itself, which is not the first place we can identify if the trend reverses, because moving averages are the first derivative, so they are going to change slower. So we have to use the faster moving average, and that for us makes 21 period moving average to be more faster, more reactive to price. To become more reactive, instead of using simple moving average, we are using exponential moving average. So if you see, based on options trading, if we have to trade options which are very high volatile instruments, where the price can fluctuate from 0 to 100 maybe in 15 minutes, we have to adapt to that. To adapt to that, we have to use faster moving average, faster price structures, and the faster style of moving average, which is exponential moving average. Now, how to identify the trend based on moving average? We'll keep it very simple. If price is trading above the moving average, we'll consider trend to be bullish. And if price is trading below moving average, we'll consider trend to be bearish. So now, if price is trading above moving average and if it forms a market structure low, that means the trend is also bullish, the pattern is also bullish. Now let us understand how to use moving averages effectively. So the first use is we are going to use moving average to understand trend and how effective the trend is. And we are also going to use a sweet spot, or we are going to identify a sweet spot on the chart, which is going to help us where to participate in the trade. So if price is trading above the moving average, we consider trend to be bullish. And if price is trading below moving average, we consider trend to be bearish. So there are two major use of moving averages. The first one is to identify whether the trend is bullish or bearish. We do it by understanding where is the average price located and whether the price is trading above the average price or it is trading below the average price. If it is trading above the average price, the trend is bullish. And if it is trading below the average line, then it is bearish. But what if the price is hovering above the moving average? It is going above the moving average, again slightly coming below the moving average, and in a way moving averages have become flat. Then what do we infer from this information? That's the reason we are going to use moving average as a channel. Whenever the price comes within the channel, consolidates for 2-3 candles within the high-low band, will declare that phase as a non-trending phase. For that part, we are not going to participate in the market. We are not going to initiate neither the trending strategy nor the non-trending strategy. We'll just avoid the markets. We are not going to plot market structure high and market structure low within the high-low channel. But if the price is trading above the moving average and just comes near the moving average to take a support, maybe 1 candle, 2 candle within the moving average, but the slope of moving average is still upwards, we'll consider trend to be bullish. But if the moving average channel becomes flat, then it becomes a non-trending zone or no trading zone for us. We are not going to participate in the markets. So either the slope of moving average should be rising or it should be falling. If the slope of moving average is rising, we consider trend to be bullish. If the slope of the moving average is falling, we consider trend to be bearish. So that is the second case. The first case is by understanding the price. If price is above the moving average, trend bullish. Plus if the slope of the moving average is also rising, then the trend is intact. The second is price trading below the moving average, the trend is bearish. Plus slope of moving average is also falling, that means the trend is intact. Bearish and intact trend. This how you can understand and use moving averages. Moving averages tend to give us a broader trend in the market. We are going to use 21 period exponential moving average and we are going to use exponential moving average channel. We are going to use high-low band to identify a good zone where we can participate in the trend. So now let us come to charts and understand how to decode trend using moving averages. So we are going to use Nifty 50 chart for the last 1 year. So if we see From 1st of Jan till 20th of Jan, price is trading above the moving average channel. It is trading above the high-low band. The trend is bullish. Now the price has started coming below the moving average from 21st of Jan. And if we see, the trend is bearish. When price started moving below the moving average and kept on coming towards the moving average, it took resistance. We call this portion as dynamic resistance. So price coming towards the moving average and falling further from there is a dynamic resistance. So if we see on 3rd of March, price came towards moving average. Maybe the candle formed above the moving average, but some part of the candle is still touching the moving average. The next candle itself started falling. It came below the moving average. So trend is bearish. Even the slope of the moving average started falling, which is suggesting that the trend is turning bearish and the trend is getting stronger. If we see on 10th of Feb, price is still below the moving average. It came towards the moving average, formed a bearish candle and started moving. If we keep on seeing, till 10th of March, price was trading below the moving average. So the trend is bearish. Now from 10th of March to 17th of March, maybe 16th of March, from 10th to 16th of March, the price was trading within the high-low channel. When the price is trading within the high-low channel, we consider this as a no trading zone for us. So this strategy is not made to be traded if it is trading within the channel. So as of now, the price is trading within the channel. So how many candles do we have within the channel? If we see, we have 5 candles within the high-low band. The entire expiry traded within that zone, which is suggesting that there is no specific direction in the markets, but these are very difficult markets to trade because there is no trend. As per the price action, the price is trading below the moving average and has come towards moving average to take a dynamic resistance. But it is not taking a dynamic resistance. So if you see in the past, price came towards moving average, formed 3 candle and started falling. It formed a market structure high. The next time, so let's say on 3rd of Feb, price came towards moving average, formed a market structure high, started falling. On 10th of Feb, came towards moving average, formed a market structure high, again there was a fall. Now from 10th of March to 16th of March, price came towards the moving average and started consolidating. If they would have to take a dynamic resistance, we should have seen a correction. But correction did not came. In fact, price started consolidating within the range. So this consolidation suggests that there is no action, no change in the trend. So these are no trade zone for us. Now going forward, from 17th of March, price gave a breakout. They moved above the moving average and started taking support from the moving average channel, which is suggesting that now the moving averages have started acting as dynamic support. So from 20th of Jan to 10th of Feb, almost for 3 months, market kept on taking dynamic resistance from the moving average. So going forward from 10th of March to 17th of March, they kept on taking support from the moving average. This concept is also known as principle of polarity. Earlier, the dynamic resistance was moving average started acting as dynamic support. So the change in polarity from dynamic support to dynamic resistance is known as principle of polarity. This principle of polarity also works in this case. So earlier resistance started acting as support is a significant information. This is giving us an idea that the trend has changed. The trend has changed from bearish to bullish. Now from 10th of March till 7th or maybe till 13th of April, price was trading above the moving average. So the trend was bullish. Now from 3rd of April till 26th of May, price was trading below the moving average and it kept on taking dynamic resistance from the moving average. So we knew the trend is bearish. Price coming towards moving average is an opportunity to go short. And how we are going to go short, I am going to discuss in a while. But this is a way of identifying support and resistance, which is dynamic support and resistance, plus it is also a way of plotting the trend. We can differentiate whether the price is bullish or bearish based on the moving average. The second is through the slope of the moving average. If the slope is rising, the trend is bullish and intact. If price is trading below the moving average and The slope of moving average is also falling. The trend is bearish and it is strong, it is intact. So we keep on taking dynamic resistance when the trend is bearish. That means the slope is bearish, the slope is downward. Every time price coming towards the moving average, we'll keep on taking dynamic resistance. If price is trading above moving average, the slope of the moving average is also upwards. That means every time price coming towards moving average might take dynamic support. Whenever the price starts consolidating within the high-low band, that's the place where moving averages become flat, which gives us no direction whether the price is bullish or bearish, or this is also a way of changing the polarity. So whenever the polarity is changing, the earlier dynamic support becoming dynamic resistance vis-a-vis, the markets will tend to consolidate within the high-low channel. If price is trading between the high-low channel, it becomes a no trade zone for us. So moving averages gives us a very clear idea or a very clear picture of how to decode trend and how to participate in the trend. Going forward in the coming sessions, I am going to explain how we can use market structure and moving averages to identify a sweet spot on the chart where we can participate, where we can initiate the trade. Now we have understood market structure, which is a way of identifying swing highs and swing bottoms, and moving average as a trend filter. If we combine both the concepts together, we'll identify a place where we can participate in the markets. And generally, these are the places which have a very high accuracy. So if you initiate a trade in that zone, you end up in a very positive trade. And this is what we are going to discuss in the coming session.